Okay, I know people are still joining, but we've got a lot to cover and not a lot of time to cover it, so we're going to get started. Welcome, everyone, to our webinar about understanding the one-time IDR adjustment. Your presenters today are myself, Betsy Mayotte. I'm the president and founder of the nonprofit organization called the Institute of Student Loan Advisors, otherwise known as TISLA. I've been in the student loan industry, feels like since the earth cooled, but for over 25 years, primarily in a compliance and advocacy role. I'm delighted to introduce my co-presenter today, which is Ashley Harrington. Ashley is currently working at the Federal Department of Education. She's just awesome. She's the senior advisor to the chief operating officer at the Department of Education's Office for Federal Student Aid. Her role there is to advise the COO on policy implementation, operations, and external communication related to the federal student loan portfolio. Prior to working at the Department of Ed, Ashley served as a federal advocacy director and senior policy counsel at the Center for Responsible Lending. While she was there, she helped shape fair lending and consumer protection reforms to address racial wealth disparities. Her portfolio included a range of consumer lending issues with a focus on student debt reform, which is one of the reasons we love her. Ashley also previously worked at the United Negro College Fund and at the New York Governor's Office. She's the author of quite a few articles and reports on student debt, particularly as how it affects Black borrowers. She's in the media a lot, which is great, and she has provided testimony before several congressional committees. She has received her BA in Public Policy Analysis from UNC. So quite a resume, and we're super lucky to have her, and I'm really grateful that she offered to co-present this really important and somewhat confusing topic. Just a little bit of housekeeping before we get going. We are recording the session. It will be posted on YouTube. I don't have the address for you yet, but I will be posting the link to the YouTube on the student loan sub on Reddit sometime next week, and also on the repayment option, specifically the income-driven plan option page on our website, TISLA's website, which is freestudentloanadvice.org. Now, we've got a really great and large group today, which I'm really excited about. But that also means that we're already getting a ton of questions. And we know that all your questions are important, but we're not going to be able to answer all your questions today. So I wanted to put a few parameters on it to make sure that the hour that we have together is as robust as possible, provides the most information as possible, and addresses the most important and popular questions. So number one, all we are covering today is the one-time income-driven plan adjustment. It's all we have time for. So we're not going to be going into the rules of public service loan forgiveness, although we will be talking about it, how it dovetails with this IDR adjustment. We're not going to be talking about the broad Biden-Harris debt relief. We're not going to be talking about the proposed new revised repay plan. We're going to have to stick strictly to this one-time IDR adjustment. Now, if you have questions about any of those other things, you could ask them in other forums. For example, as I mentioned, TISLA provides free student loan advice. At the end of this presentation, you'll see how to be able to reach out to us to ask us. There's also your loan servicer. And finally, there's the Department of Education itself through FSA chat. And we've included a link to that at the end of this presentation as well. Speaking of questions, I want to remind you this is a public forum. So you want to avoid asking detailed personal questions because this is public. Remember, it's going on YouTube as well. And, you don't need other people knowing your business. So you're going to want to leave out, and we're probably not going to answer detailed personal questions just to sort of protect your information. Now, again, I know everyone's anxious and they have their particular question that they really want answered, but I am going to ask, because we have such a large crowd, to hang tight on your question until we've covered the topic. If Ashley and I are doing our jobs well, and we're both going to do our best to do our jobs well, we will answer your question as we go. Now, if we get past your topic and we haven't answered your question, then absolutely throw it up into the Q&A, and if we have time, we will answer it. And I think that covers it. Ashley, did I leave anything out of the housekeeping?
Nope, sounds good to me.
All right. Well, then let's dive right into this. So here's how we're going to roll. I'm going to start you off and I'm going to give us some background. Mainly, I'm going to explain and do an overview of the income-driven plans. I'm going to give a bit about the plan specifics, and then I'm going to pass the baton over to Ashley, who's going to get into the meat of the issue, which is the one-time IDR adjustment. She'll go into specifics about how the one-time IDR adjustment works. We're going to talk about timing. We're going to talk about consolidation. We're going to talk about Parent Plus loans. And by we, I mean her. And then once we're done with that, we're going to answer as many questions as possible. Okay, so let's get into an overview of the income-driven plans. Now, the income-driven plans, believe it or not, are fairly, if you think about the 50, 60-year history of the federal student loan program, income-driven plans are babies. They're fairly new to the program. The very first one was introduced under the direct loan program only back in 1994. And quite frankly, it was very rarely used, partly because the vast majority, I'm talking like 90%, of borrowers up until 2010 didn't have direct loans. They had what we call Federal Family Education Loan Program loans. And the other reason is, in many cases, ICR, or the Income Contingent Repayment Plan, which is the one that was introduced in 1994, that plan can sometimes be more expensive than some of the other options. After that, we didn't see another plan based on income really until 2009, and that's what we call old IBR. Now, the FEL program did have something called income sensitive repayment. It still does, but ISR it's similar but very, very different, and we don't consider it one of the income-driven plans, mainly because there's no forgiveness component baked in to the income sensitive repayment plan. So we're not going to be talking about that one at all today because we don't consider it one of the quote unquote income driven plans or IDR plans. Now, one of the things that all the IDR plans have in common is they do have a forgiveness component baked in, so to speak. And the way they're all the same except where they're different. And where they're the same is that if you're on an actual income driven plan for either 20 or 25 years, and that time frame depends in part what plan you're on, and in some cases depends on what kind of loans you have, and you still have a balance after that 20 or 25 years, that balance is going to be forgiven. Now, it doesn't matter what you do for a living, if you're working, who you work for. Unlike public service loan forgiveness, there's no real employment component to the forgiveness that's baked in to the income-driven plans. The other thing about the forgiveness that's baked into the income-driven plans is that they all cross-pollinate. So you don't have to be on the same income-driven plan for the whole 20 or 25 years. So you could be on old IBR for 5 years, then maybe you trot on over and decide that pay as you earn is a better plan and you're on that for another 5, and then maybe you go to repay for the remaining 10 or remaining 15 years. All of that's fine. They all cross-pollinate with each other. The other thing they have in common is they all base your payment on a percentage of your discretionary income. And I'm going to define discretionary income for you in a few minutes. Discretionary income is generally adjusted gross income, which is what you see when you file your taxes, minus either 100 or 150% of the poverty level that's based on your family size and state. Now, the poverty level is the same in 48 of our states. Alaska and Hawaii have slightly higher poverty levels, but the rest of them are the same with each other. And the poverty level is adjusted on an annual basis. We have a link to where you can see what the poverty level is on the IDR page of our website. I believe the Department of Education has it on their IDR page as well, but it's also a simple Google search. Poverty level for my state, it'll pop right up for you. The other thing that these plans all have in common is that they all require an annual recertification of income, except during COVID. So none of you, unless perhaps you consolidated recently or decided to do it on your own, has been required to recertify your IDR plan since March, right around March of 2020. And you most likely won't be required to recertify your income until a few months at least, if not longer, after the COVID waiver period ends, which as of right now is tentatively August. Okay, so getting ahead of me, computer. Okay, so let's talk about the different IDR plans. So let me just start off by saying that one thing that we're not in the student loan policy world is creative when it comes to naming things. We literally do have something called old IBR, and we also have something called new IBR, and they're both exactly the same except where they're different. Now, old IBR is a program that both Federal Family Education Loan Program loans, or FFEL, and direct loans are eligible for, except Parent Plus. Parent Plus are not eligible for old IBR in either program. That's the only income-driven plan that's available to FFEL borrowers. New IBR came about around 2014, and that's only available to direct loan borrowers. Again, Parent Plus are not eligible. Pay as you earn, again, is only direct loan borrowers. We also call that payee. Revised pay as you earn or repay, again, is only direct loans. And then income contingent repayment, our old man of an IDR, again, it's only direct loans. And for this one, however, Parent Plus loans can become eligible for ICR, but only if they're consolidated. Now, we're not going to have time to go into this in gory detail, but there is a way for Parent Plus loans to become eligible potentially to some of the other plans, and that's through something called double consolidation. Now, again, unfortunately, we don't have time to go into that, but we do have it explained in detail on the consolidation page on our website, freestudentloanadvice.org. So let's talk about that discretionary income and how it works. For all the plans except for ICR, they're using 150% of the poverty level for the state you're in and your family size. So the calculation that's used for discretionary income is they take your adjusted gross income. Other than ICR, they subtract 150% of the poverty level for your state and family size. So just for the sake of example, let's say the poverty level for your state and family size was 20,000, except for ICR, they would subtract 30,000 from your AGI, and that gives them the discretionary income. So let's look at an example with some real numbers. If you have an AGI of 62,000, you have a family size of 4, you're living in the state of Maryland, they're going to take 62,000 and subtract 150% of your poverty level, which is 26,200. 150% of that is 39.3. That leaves them with 22,700. They divide that by 12, which gives us 1892. And then depending on which plan you're approaching, whether that plan looks at 10% or 15% of your discretionary income, that's going to decide what your payment's going to be. So for example, new IBR and pay as you earn looks at 10% of your discretionary income. So if that's the plan you are pursuing, with this example, your payment would be $189. Old IBR looks at 15%. So in that case, your payment would be $283. Now, if you're using ICR, they're only subtracting 100% of your poverty level. So in this example, they'd be taking 62,000 of the AGI and subtract 26.2, and then obviously you would end up with a higher payment. In most cases, we're going to talk more about ICR in a few minutes. Now, for married borrowers who file their taxes as married, the AGI is the total AGI for both spouses. Now, if both spouses also have loans, They will also take both loan balances into account when they're doing the calculation as well. For married borrowers who file their taxes as married filing separately, with the exception of repay, they're only going to use the borrower's income. The other exception there is community property states. The way community property states work is instead of just looking at if you do married filing separately, they take half of the married couple's AGI, rather than specifically what the borrower's specific AGI is. Now, for the repay plan, if you are married, again, in 99.999% of the cases, regardless of your tax filing status, they are going to look at both spouses' income. There is an exception for situations where the spouse truly does not have access to the other spouse's income. That was put into place mainly, but not exclusively, for cases of domestic violence. Now, if you're married and you're filing jointly, chances are you are going to have access to your spouse's income because it all sort of ends up on the same tax return. All right, now some of the plans, specifically old IBR, new IBR, and pay as you earn, require, in order to enter into the plan in the first place, requires that you have what we call a partial financial hardship, or PFH. A PFH exists when the annual amount due on the loans that are going to be under the plan, as whatever your 10-year standard payment amount would be, exceeds what your IDR payment would be. So in the case of old IBR, 15% of your discretionary income, or in the case of new IBR, 10% of your discretionary income. So to use the example that we had on the prior slide, if your let's say your student loan balance was $60,000, under a 10-year standard plan, your payment would be around $720 a year. $720 a month. Now, under both the 10 or 15% discretionary income, if you remember, both of those come out to lower than the $720 a month. So in this scenario, this borrower would be considered to have a partial financial hardship, because both the 189 and the 283, no matter which plan you're looking at, is lower than the 720. Therefore, they're considered to have a partial financial hardship. So they would be potentially eligible, assuming all the other eligibility criteria was met. They would be able to get into old IBR, new IBR, or pay as you earn. All right, I'm going to quickly go over the basics of the individual plans. So first of all, let's talk about old IBR. Now, as I mentioned, both FFEL and direct loans are eligible for old IBR. And by the way, in all these cases, I'm excluding defaulted loans. Defaulted loans at this stage are never eligible for any of the repayment plans. As I mentioned, old IBR, any FFEL or direct loan except a Parent Plus loan or a consolidation that contains a Parent Plus loan, they use 15% of your discretionary income. You are required to have a partial financial hardship. The forgiveness component happens after 25 years under this plan or a combination of the plans. Now, there is an interest subsidy on most of these plans. Now, the way the interest subsidy works for old IBR is it applies to your subsidized loans only. And it applies for the first 3 years that you're under the plan. And what it means is if your calculated payment is lower than the amount of interest that's accruing, then the government is going to forgive the difference in interest. So, for example, let's say you only had subsidized loans and you were accruing $50 a month in interest. And under old IBR, your payment was $25 a month. You'd pay the $25 a month, and for the first 3 years you were under the plan, the government would pay the other $25. Now, if in year 2 your payment went up to $30 a month, in that case, the government would pay the extra $20. So for old IBR, the interest subsidy only applies to the first 3 years. It only applies to subsidized loans. Now, new IBR, only applies to borrowers who all of their loans were made on or after July 1st, 2014. It also requires a PFH, a partial financial hardship. And for new IBR, they're looking at 10% of your discretionary income rather than the 15. The other nice thing about new IBR is it forgives in 20 years instead of the 25. And the interest subsidy that applies to new IBR is the same as old IBR, which is 100% of the difference in interest between what you're paying versus what's accruing for the first 3 years on your subsidized loans only. Pay as you earn. It's very, very similar to new IBR. The difference is who's eligible for it. Pay as you earn is only for direct, what we call new direct loan borrowers, who their first loan that they had was made on or after October 1st, 2007, and who received at least one disbursement on a loan on or after October 1st of 2011. Other than that, it's exactly the same as new IBR. The PFH requirement, the 10% of discretionary income, the interest subsidy, and the forgiveness part is all exactly the same as new IBR. The only difference is who's eligible for it. Revised pay as you earn. Now, remember, what we're talking about now is the existing repay plan. There is a proposal and some draft regulations out there that will make significant and really awesome changes to repay if it goes through as the draft is written. We don't know when that will happen. We're not going to be able to answer any questions about it on in this session, so save your fingers some typing time on that. But what we're covering here is the existing repay plan. Now, the existing repay plan, again, is direct loans only and not Parent Plus or consolidation loans made up of Parent Plus unless it's a double consolidation. Repay also looks at 10% of discretionary income. You do not need a PFH in order to enter repay. But what that also means is that unlike the other plans that I've already talked about, the limit of how high your payment can go is unlimited. So as your income goes up, your payment will go up just like the other plans. But what old IBR, new IBR, and pay as you earn do is that it caps your payment. As long as you're on the plan, it caps your payment at whatever your payment would be under a 10-year standard plan. So if we go back to the example I talked about on the prior slides, if you were on pay as you earn, old IBR or new IBR, once your payment got around the $720 range, even as your income continued to go up, your payment would cap at the $720. In repay, as your income went up, if the payment calculated at say $900, that would be your payment under repay would be $900. Now at that point, you could try to switch to another plan, but remember, excuse me, to get into those other plans, you do need to have a partial financial hardship. Now, the interest subsidy for repay is a lot more generous than the other plans are. Now, what's the same as the other plans is that it forgives 100% of the interest on subsidized loans for the first 3 years. And by 100% of the interest, I mean the interest that's not satisfied by your calculated payment. But what it also does is it forgives 50% of the unsatisfied interest for as long as you're on the plan on all the loans. So if your payment is always less than the interest that's accruing, as long as you're on the repay plan, the government will forgive half of what's not covered by your calculated payment. So let's say, going back to the example I used before, let's say all your loans were accruing $50 a month in interest and your payment was $25. For as long as you're on repay on both subsidized and unsubsidized loans, they're going to forgive half of that additional $25, so $12.50. Now, the forgiveness on repay is a little bit different as well. You get forgiveness on the repay plan after 20 years if all of your loans are undergraduate loans. It goes up to 25 years if you even have one graduate loan. So to be really clear, It's not that if you have a combination of undergrad and grad, it's not that on repay they'll forgive the undergrad portion at 20 and the graduate portion at 25. If you have a combination, they're not going to forgive any of it until you've been on this or a combination of the plans for the 25 years. All right, let's talk about ICR. ICR, we love to hate it. We love it because it opens up income driven plans to Parent Plus borrowers, specifically Parent Plus loans that have been consolidated. And for ICR, you only need to have consolidated the Parent Plus loan once, whereas that double consolidation method I alluded to earlier, you would have had to consolidate the Parent Plus loan twice. ICR is a little more complicated. Where it's similar to the other plans is they do use a discretionary income component, but in this case, they're using 20% of your discretionary income. But the other thing they look at is what your payment would be under a 12-year standard repayment plan, multiplied by something called an income percentage factor, which I've given you a link to an income percentage factor below. And then they're gonna take whichever the lower is of those two payments. So while I said earlier that ICR tends to be the more expensive of the IDR plans for most borrowers, there's a reason I'm using tends to be in most instead of always and all. I have seen cases which, because of this 12-year standard payment component, where the ICR plan actually is the lowest of the IDR plans for a borrower. So never, especially if you're pursuing something like public service loan forgiveness, where you want the lowest payment possible, don't discard ICR out of hand. You should run the numbers on all the plans. Now, unfortunately, ICR does not have any type of interest subsidy, but it does have a baked-in forgiveness component, which is 25 years on this or a combination of the plans. A couple other things about the ICRs before I pass the baton. Under IBR, old IBR, new IBR, ICR, and pay as you earn, they're going to use the spousal income if you're married, filing your taxes as married. But if your spouse also has student loans, they will include your spouse's student loans in the calculation. Many times, for married borrowers who both have federal student loans, not always, again, you need to run the numbers, but many times the lowest payment for the household is going to be if both spouses are on an income-driven plan. When a borrower no longer has a partial financial hardship, which remember is required for both old IBR, new IBR, and pay as you earn, the payment is based, it's not going to go any higher than what your payment would be under a 10-year term for whatever your balance was when you first entered the plan. So not your original balance, but whatever your balance was when you first entered the plan. Now for repay, as I mentioned, they're going to use your spouse's income regardless of tax filing status, except in extreme cases where the spouse truly does not have access to the other spouse's income, such as in cases of separation or domestic abuse. And again, for repay, there's no maximum payment amount. Now, just a quick overview of how forgiveness works under traditional IDR rules. Now, in order to get forgiveness under traditional rules, which, have applied before and are going to apply again after this IDR adjustment is made, you have to be on an actual IDR for the full 240, which is 20 years, or 300 months, which is 25 years, for the balance to be forgiven. Now, payments made under a 10-year standard plan also count towards this calculation. Now, they don't have to be consecutive, and you could have some deferments and forbearances thrown in there, but you do have to be on an actual IDR plan for every one of those months in order to get forgiveness under traditional IDR rules. Now, normally, consolidation resets your IDR account to 0. Now, we do have some new rules coming starting July 1st of 2023. If you consolidate after that date, it won't reset the IDR count to 0, but will instead give you a weighted average of the counts of the underlying loans. So, for example, if you consolidated after July 1st, 2023, and some of your loans had 50 payments under an IDR plan, and some of your loans had 25. I probably should have picked numbers that were easily averaged out, but you'd end up with somewhere around 30 or 35 payments. Now that's different under the IDR adjustment, and that's something that Ashley is going to cover. Periods of deferment or forbearance of default don't count currently under traditional IDR rules, with the exception of economic hardship deferment. Economic hardship deferment has always counted towards the IDR forgiveness count. And beginning July 1st, 2023, there will be some other periods of deferment that will count. We don't have time to cover those today, but you will be able to see which of those will count as we get closer to July 1st, both on the Department of Ed's website as well as ours. Now, as I mentioned, you don't have to be on the same IDR plan the whole time. The IDR payments don't need to be consecutive. Your employment's not relevant. It also doesn't matter who makes the payment. We see this most often with Parent Plus loans. Maybe the child for whom the Parent Plus loans were taken out for is the one actually making the payment. But the IDR plan is based on the parent borrower's income. That's okay. We don't care who's making the payment, but the income is always based off the actual borrower of the loan, regardless of who's making the payment. And IDR payments almost always count towards PSLF as long as at the time the payment was made that the borrower was working for PSLF eligible employment. And if you need more information about public service loan forgiveness, I encourage you to go to the Department of Ed's website, studentaid.gov, or our website, freestudentloanadvice.org. Now, before I hand it off to Ashley, are there, and I guess I will ask, either Pat, Addison, or Kaylin, are there any questions about the existing IDR rules, the traditional IDR rules that you think I should reiterate or cover before I pass the baton? And I am not hearing any, so I don't want to waste any more time. So, Ashley, are you able to move your slides, or if you want me to do it for you, or?
Yeah, I don't think I'll be able to move it myself. So if you don't mind, that would be great. Hi everyone. Thanks for joining, and thank you to Betsy for laying out a lot of the intricacies involved with IDR and IBR plans so well. I get to talk about the exciting part, the less complicated part, or the part that's supposed to uncomplicate so much of what we heard. That happens with IBR. So I'm going to talk about the one-time account adjustment. Now, if you are familiar with the PSLF waiver, some of this will sound familiar to you because they act similarly in many ways, but they're also different. So we're going to go ahead and dive in. We can go to the next slide.
You might be able to do it now. You might want to check. I made you a co-host.
I think I would have to share my own screen, right?
Okay, never mind. I gotcha.
Okay. So this is something we announced last April, seems so long ago now. And these are updates to how we calculate payments for IDR. So we're doing this one-time revision, and it's going to address past inaccuracies, forbearance steering, and issues with deferments. And so under this adjustment, similar to the PSLF waiver, borrowers are going to get credit for past periods of repayment and forbearances that they normally can't get credit for IDR or PSLF. So the PSLF waiver ended, but you still have time to take advantage of this adjustment. And the way you take advantage of it is different. And so this adjustment applies to all borrowers who have ed-held loans. And so those are loans that are basically on the payment pause. If you have loans that you haven't had to pay for since March of 2020 that haven't been accruing interest, these are ed-held loans. And it's going to be applied automatically to all ed-held loans, including ed-held Parent Plus loans, including loans for borrowers who are in default. Now, if you're in default, it's slightly different. You can't get public service loan forgiveness, but everyone is going to get this updated account revision adjustment. We can go to the next slide. So for folks who don't have Ed Held loans, the biggest thing that we want to make sure we stress today is if you still have Fell loans or Perkins loans, or some of the older loans that aren't included in the Ed Held loans, or you haven't been on the payment pause, you still have time. You can consolidate those loans and take advantage of this adjustment. We're going to talk about what consolidation means, some of the pros and cons a little bit, but you still have time if you still have Fell loans or Perkins loans to consolidate and take advantage of this adjustment. So under the adjustment, you're going to get credit for any month in a repayment status, regardless of the payment you made, the loan type, or the repayment plan. It excludes periods where you're actually in default, but if you were just delinquent, it would include that. It includes some forbearances and deferments. We're going to talk about that on the next slide. And it includes any time in repayment prior to consolidation on consolidation loans. So whereas normally when you consolidate, you start at 0 for PSLF and IDR purposes, through the adjustment, you will not start at 0. Now for PSLF, you may temporarily reset to 0, as some people saw with the waiver, but you will get all that credit for the underlying loans. So this includes loans that have been consolidated multiple times. So if you had a failed consolidation loan and you consolidated that into a direct consolidation loan, you would get credit for the underlying loans. It includes consolidated direct loans. So if you have a bunch of direct loans and you consolidated them, or you had one direct loan and you consolidated that, you can get credit for the time on that underlying loan. It includes consolidated Fell and Perkins loans. So whereas you would normally start at 0, I want to be clear, under the adjustment, that is not the case. You can still get credit for the underlying loans. Next slide. So the consolidation loan will get credit for the time of repayment on the underlying loans with different counts. So what that means is your consolidation loan will be credited with at least the largest number of payments on the loans that were consolidated. Because for many folks, their loans that they consolidated will have overlapping repayment periods. So if they're completely overlapping, you're going to get that largest number of payments. If they're not totally overlapping, you may get more than that largest number of payments for the months that don't overlap. So it just depends. And again, normally you reset to 0 for PSLF and IDR, but not under the adjustment. But you do have to consolidate your loans prior to the one-time adjustment to take advantage of this. So as long as you do it before we actually do the adjustment, you will get all these benefits. Next slide.
Ashley, I just want to throw in there because I know people will ask, if all your loans already have the same count and you already have loans that are eligible for the pause, you don't need to consolidate. The only people that need to consolidate before the one-time adjustment are the ones trying to take advantage of this higher count issue, correct?
And the folks who still have Fell loans, and if you're trying to get PSLF, even if you still have Ed Held Fell loans, so you've been on the payment pause, but they're still Fell loans, for PSLF, you would still need to consolidate those.
Perfect. Thank you so much.
No problem. Let's go to the next slide. So deferments and forbearances, what are you automatically going to get credit for if you have these eligible Ed Held loans? We're counting long-term forbearances, which we define as 12 or more months consecutive or 36 or more months cumulative. So if you have these long forbearances on your account, you're going to get credit for those periods towards IDR or PSLF. We're going to give you credit for deferments prior to 2013, as long as it wasn't an in-school deferment. You get credit for economic hardship deferments, though not unemployment deferments. There's also going to be credit for some military-related forbearances and deferments. And so we know some folks were also steered into shorter-term forbearances, and there will be a process later. It won't be automatic, and we're still working out what that process looks like for folks to be able to get credit for short-term forbearances as well. Go to the next slide. So through the account adjustment, many borrowers are going to get discharged automatically. And so borrowers who reach 240 or 300 months worth of payments, and we'll talk about next who's at the 240 and who's at the 300, or 120 months for PSLF, are going to begin to see their loans forgiven later this year. So we're going to do this automatically where we can. And later on, you'll be able to track your IDR count right on studentaid.gov. That'll be late this year, really late this year, but stay tuned. The same way you can currently track your payment count for PSLF on your student aid dashboard, you'll be able to track your IDR count. Let's go to the next slide. So I want to flag a few things about consolidation. I like to highlight these because a lot of folks are going to have to consolidate or are considering consolidation as they think about how to best manage their student loans. So when you consolidate, your monthly payment can change. And as Betsy laid out, many of the plans require you to have a partial financial hardship. So if you no longer have that, you could lose access to some IDR plans. If you have unpaid interest, your principal balance is going to go up because it's going to get added to that principal balance. Your new consolidation loan will generally have a new interest rate, and it'll be a weighted average of all the interest rates on the loans. And you don't have to consolidate all of your federal student loans. When you go to the consolidation application, you'll be able to pick and choose which loans to consolidate. And for some folks, that's really important, especially because, we're not going to talk too much about debt relief, which we just had the Supreme Court argument next week. We truly believe that we have the authority to do this. We're waiting on the Supreme Court to make their decision. But we want to make sure folks know that if you have commercially owned FEL or Perkins loans and you consolidate them with direct loans, you could lose eligibility for one-time relief. So that's something that folks may want to think about. But you could consolidate those commercially owned FEL loans or Perkins loans separately, not with your direct loans, and think about that. So just everyone has their own unique situation, just putting the information out there, and you have to make the decision that makes the most sense for you. Let's go to the next slide. So this is one I'm really excited about, Parent Plus loans. A lot of folks are struggling with Parent Plus loans. It's how so many folks have been able to send their kids to college, so many people of color in particular. And so really excited to note that Parent Plus loans are eligible to receive additional credits through the one-time adjustment for both PSLF and IDR. Now, Parent Plus borrowers were not able to get additional credits through the PSLF waiver, which ended the end of October, but they will get additional credit for both PSLF and IDR through the one-time adjustment when we run it. And so direct consolidation loans that include Parent Plus loans and other loan types are eligible to receive additional credit for the time and repayment on the Parent Plus loan. If you still have FEL Parent Plus loans and you consolidate those, you will be able to get credit for that underlying FEL Parent Plus loan through the adjustment. Let's go to the next slide.
Before I do, I just want to point out that I happen to know that this is something that Ashley fought very hard for. And as someone who has always had a soft spot for Parent Plus loans borrowers myself, I want to make sure that she gets credit where it's due. She really is one of the unsung heroes when it comes to ensuring that Parent Plus loans actually did get included under these waivers. So thank you for your hard work on that, Ashley.
Oh, I appreciate that, Betsy. It is really exciting. A whole entire team worked on it, but it is very, very exciting that we were able to get this done for parents. And so I want to talk a little bit about timing. So this is going to happen. It's going to take a while. If you know how student loans works, there's a lot of different people involved, stakeholders involved. We have the servicers, we have our team, we have our NSLDS system, which feeds all the data. We have so many different moving pieces. So a lot of the things that we do, especially the transformational things, take time to implement. So we're going to ask you to be patient with us. We're going to do all of this later this year. We're going to update you on timing as soon as we can. We are working through some of those pieces so that we can give you the most up-to-date information. We will, as soon as we have more up-to-date information, it will be on the IDR adjustment website, which we'll show the link for later. But you just want to make sure whatever happens, you get this done before the adjustment occurs, and we will make sure you have the notice and information that you need. And so borrowers who reach 240 or 300 months worth of payments, or 120 months worth of PSLF credit will get their loans forgiven later this year. And here's a little flow chart to show you what's going to happen operationally. We're going to run a file through our system. Then we're going to send people who are at that forgiveness level to their services to get discharged. And we're going to send later updates for folks to just get updates to their account if they're not ready for discharge. Let's go to the next slide. And so just a little bit about what's going to count like in terms of how far back are we going to go? So for PSLF was created in October 2007. So you only get credit for time after October 2007 towards PSLF. Now it includes all of the different periods that we talked about earlier, but it only includes time after October 2007 for PSLF. For IDR, the first IDR plan was created in 1994. So you're only going to get credit for time after July 1994 towards that 20 or 25 years, right? Now, for the forbearance steering, when we talked about the long-term forbearance steering, 12 or more months consecutive or 36 or more months cumulative, that can go beyond the October 2007 or July 1994. So if your 12 months was started in 1993, or your 36 months included time in 1990 and 1991, but over the course of your loan, you have 36 months cumulatively, you're going to get credit towards your IDR for any of those extra months after July 1994. So you won't get credit for the time prior to that, but that time will contribute to whether you beat that threshold for the long-term forbearance steering. So you'll be able to track your progress toward forgiveness. If you're doing PSLF, you'll be able to check it on mohila.com. That's the PSLF servicer, as well as on studentaid.gov on your dashboard. And as I mentioned, later this year, you'll be able to track your IDR payments right on studentaid.gov as well. Next slide. So we mentioned 20 years, 240 payments, 300 payments, 25 years. And so I bet some folks are confused. And Betsy talked a lot about timeframes earlier. So basically, if you're enrolled in pay, no matter what type of loan you have, you're going to get forgiveness at 240 months, 20 years worth of payments. All Parent Plus loans are 300 months, 25 years. Because remember, Parent Plus loans can only get one type of income-based repayment, that's ICR, and it's 25 years. If you have grad loans and you've never been on IDR, it's going to be 300 months, 25 years. And if you just have undergrad loans, it's going to be 240 months or 20 years. And this is just based on how the different IDR plans work. Because remember, for some folks are going to get this, we're going to apply this to everyone, not just people who are in IDR right now or who have ever been in IDR. No matter where you are, if you have Ed Help loans, we're going to apply this to your account. And if you meet that threshold for whatever type of loans you have, no matter whether you're enrolled in an IDR plan right now or not, you are going to be eligible for discharge and you're going to get updated counts. Next slide. So this is just like a chart that kind of summarizes what we talked about. For payment counts, you're going to get credit for months in repayment status, regardless of the payment made, the loan type, or the repayment plan. You're going to get credit for time of repayment prior to consolidation on your consolidation loan. So remember, you're not starting at zero. We're going to do automatic forgiveness where we can at 20 or 25 years for all borrowers, even if they're not currently on an IDR plan. We're going to give credit to non-eligible loans. So if people who still have commercially managed FEL or Perkins loans or other non-direct loans can consolidate and not start at zero and get credit, as long as they do it before we do the adjustment. And folks who have Ed Help FEL loans or just FEL loans in general, who missed out on the PSLF waiver, can still consolidate and get PSLF credit if they do it before we do the adjustment. And for folks who reach forgiveness and they've made enough qualifying payments that they exceed the forgiveness threshold, that 20 or 25 years, they will get refunds on any overpayments they made. Next slide. So you can learn more about the account adjustment. Here's that website. We are going to update it soon. I know folks are like looking for FAQs. I know we all are. They will be up there shortly. I will let Betsy know as soon as they're available, and I'm sure she will blast it to the world. So stay tuned. That is coming. We want to provide as much information as possible, so that will be forthcoming. We'll go to the next slide. And I think we're ready for questions, Betsy.
Awesome. So I'm going to start with asking you questions, Ashley. Just to cover some of the things that we get asked most often about this at TSLA. And maybe we'll try a true or false format. How does that sound? I'm going to take silence as acceptance. True or false, Ashley? A borrower with all direct loans that has all the same payment count doesn't have to do a darn thing to get this IDR adjustment.
True.
True or false? Payments made or periods of time when a loan is in default will not count towards either the IDR adjustment or PSLF.
True.
What was my third one? True or false? As long as the borrower for borrowers that do need to consolidate, as long as they've applied for the consolidation before the IDR adjustment, it'll be credited under the IDR adjustment.
True.
So in other words, the consolidation does not have to be completed and funded by then.
True. As long as, well, it will need to be done before the adjustment occurs, but we're going to make sure folks know. So right now, I think our website says May 1st because we're currently planning to do it based on the current plan is due in July. But if that gets pushed, we will let folks know and give them the best opportunity to make sure that gets done, because consolidation takes 30 to 60 days.
Okay, great. So just to reiterate, as of right now, as long as for those that do need to consolidate, as long as they've submitted a completed consolidation application by May 1st, then it'll count under the IDR adjustment. And if that deadline gets pushed up, that gets pushed up, but the same premise applies.
Absolutely.
Okay. True or false? There are ways for people that are anxious to get their IDR adjustment sooner rather than later. There are ways to get pushed up in line.
False.
So just like the PSLF waiver, it's gonna happen when it happens. As I like to say, people need to put their patience pants on. But it will happen automatically. That it does not require any type of app. There's no application for the IDR adjustment, is I guess what I'm trying to say.
Yes.
Did I miss any FAQs, Ashley, before we see if our fine feathered friends that have been working the Q&A have any they want to ask us?
I don't think so.
Okay.
And I like the true false format.
Yeah. Good. I'm glad, because I didn't warn you ahead of time I was going to do that. So thanks for playing. All right. So our team that is on has been diligently trying to answer as many questions as possible in the Q&A. I guess we'll start with Kaylin. Is there any question that you're getting a lot of that you think one of us should reiterate, or maybe something we didn't cover at all?
So
I think a common question, and I know Ashley touched on it, is the time in default around the IDR one-time account adjustment and how that will work for borrowers who may have defaulted on their loan.
Absolutely. So you won't get credit for time when you're in default, but you'll get credit for any of the other periods. Like even if you were delinquent, you can get credit for that time. And so borrowers who are in default, if you happen to have 20 or 25 years of repayment prior to defaulting, you may even be able to get discharged when we run this adjustment. But if you're trying to get PSLF forgiveness, you will have to get out of default and things like that. And going forward, you want to figure out how to you'll have to manage your default. But we have this excellent program, Fresh Start, to help all defaulted borrowers. Studentaid.gov/fresh start. If you are in default, check that out, so you can take full advantage of all of these benefits happening right now.
So just to further clarify, Ashley, if I've been in repayment for 25 years, but 10 of those years were in default, I'm only going to get credit for how much?
You're only get credit for 15 years.
Okay, thank you.
Yeah, I was like, yes.
I just remembered another true and false question I wanted to ask you, Ashley. True or false? Once the IDR adjustment has been done, and if I haven't reached the forgiveness threshold for either PSLF or the income-driven plans, do I need to be on an IDR to accrue future IDR payments? True or false?
It's a great question. So yes, going forward, you're gonna want to be on IDR after we stop running like what we call direct to discharge files, right? You want to be on an IDR plan. If you're 10 years in or 15 years in, later on you are going to want to get on IDR and help you manage your loans. But whatever payment count you get through the adjustment, that will be your payment account
forever.
We're not going to, once the adjustment is done, you're not going to get rid of it. That'll be your account for PSLF and for IDR, and you'll be able to move forward from there.
Unless you consolidate, unless you consolidate after July 1st, in which case they do a weighted average.
Yes.
Okay, Pat.
If you consolidate after we do the adjustment, it will be based on the consolidation rules that are in effect then. So under PSLF, it's a weighted average. That's also what was part of the draft rule. So it will be different rules, but you wouldn't start completely at zero. For PSLF, and it's only a weighted average for direct loans, not FFEL loans.
Really good point. Thank you for clarifying that. Pat, are there any questions that you think we need to answer or further clarify?
Yes. So one is, we got a number of questions on spousal consolidations, both direct ones and FEL. And I think people, especially the FEL people, need to understand what it is they need to do.
Oh, great one, Pat. Ashley, do you want to cover that, or do you want me to take a stab at it?
So for I'll start if you want to add anything. So for FEL spousal consolidation loans, we are very excited that Congress gave us the ability to allow these folks to get unconsolidated basically and get into direct loan program. That is something that is going to take a while to implement, and we will keep people posted. Stay tuned, stay on student.gov. We will let Betsy and borrowers know when that process is available, but that will take time. But our goal is to make sure that all borrowers have access to all these programs. And if you have direct spousal consolidation loans, you're included in the automatic adjustment. So that will apply to your loans already.
Perfect. Thank you. Addison, is there anything that you spotted that you think we need to clarify or answer?
Yes, we had a number of questions on what or whether loans that were being repaid through Chapter 13 bankruptcy would count.
So time in bankruptcy does not count, but but they should still be able to get a payment count. I want to clarify that. You definitely don't get credit for time in bankruptcy, but you would get credit for the other time.
For what it's worth, Ashley, that was my understanding too. It's treated the same as a default status. So
Right.
you get a count for all the times you weren't in Chapter 13, but the period in Chapter 13 in and of itself wouldn't count. That was my understanding.
Right. I was just thinking with like those loans, making sure those loans still show up on our system the same way. And I'm pretty sure they do. It was more that piece.
I see. Picking up what you're putting down.
Yeah. But
Okay.
I think we're good.
All right. Well, we are just at 2:00. I know that there's I can tell from the Q&A panel that there is still a ton of questions in there. Hopefully we answered most of them inadvertently, even if we didn't answer them directly. I do encourage you to check out studentaid.gov. They have an awesome calculator called the Loan Simulator tool, where you can get an idea of what your payment would be under the different income-driven plans. We have a calculator on our website as well. There's also, we've given you the link here for the IDR adjustment information. If you do have more specific questions that we didn't address here, or you didn't ask because you took my sound advice about not airing your personal financial information on a webinar, you can use FSA chat. You can go to your loan servicer, or of course, here at TSLA, if you use the TSLA email address, we offer free one-on-one counseling via email only. We try to answer most questions within a business day, and I know that FSA tries to be equally responsive, as well as the servicers. I cannot thank FSA, especially Ashley and Kaylin and their team, and all the people in the background whose names you will never hear, for all your hard work, especially under challenging times. I know that there are budget issues, and these are all really big programs that have been instituted in the last couple of years, and that you have all worked really hard for borrowers. And I just want to say how much I appreciate that, and how much I appreciate that you took time out of your busy schedule to do this webinar on this really important topic with us. So I can't thank you enough for that. And of course, thank you to the Q&A team, Addison, Kaylin, and Pat, for working this for us. And for those of you who loved this so much that you want to listen to it again, we will be posting it on YouTube, hopefully by this weekend. And I will post a link to the YouTube on the IDR page on TSLA's website. And I will also post it on the Student Loan Sub on Reddit once it's available. So anything else you want to add, Ashley?
Nope, just thank you for putting this together. Thanks to everyone for joining. Thanks to Kaylin and your team for managing all of this. And remember, keep on studentaid.gov. That's where you're going to find the most up-to-date information, and take advantage of all of these different avenues for relief that we have available.
Here, here. All right. Take care, everybody.